We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Global markets hit a wall this week. The Nasdaq tumbled 3%, the S&P snapped its 3-week win streak, and AI-heavy tech names saw their first real valuation reset as investors demanded proof over promise. The record U.S. government shutdown deepened, freezing confidence, crushing consumer sentiment, and raising stagflation fears. Across the Atlantic, Europe's data softened again. Retail sales fell for a third month, while a divided Bank of England held rates, exposing cracks in growth. In Asia, Japan's Nikkei slid over 4% as yen strength and wage gains fueled bets on tighter policy, while China eked out a fragile rally on a temporary U.S. trade truce that lifted sentiment, but not fundamentals. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
Wow. After months, really, of euphoria, where it felt like investors were just ignoring everything, geopolitics, policy risk, the global markets just slammed on the brakes this week. We're talking a sharp pullback, a decisive reality check, maybe, for anyone thinking that rally could just keep running forever.
Yeah, it wasn't just a simple dip. It felt more like the consequence of all that policy risk we've been talking about finally hitting valuations that were already looking pretty stretched. And looking back, two things really jump out as the drivers here. A definite repricing in those big AI-driven tech names, and the growing shadow of this U.S. government shutdown, which is now the longest in history.
Okay, so our mission today, give you the ultimate shortcut through this chaos. We'll hit the U.S., Europe, UK, Japan, China, razor-sharp summary, what mattered, what didn't. Then we look ahead. Next week's calendar, and, crucially, the top 5 risks you absolutely need to watch now. Let's unpack it all. So, the explosion really started in the U.S. markets, didn't it? Equities snapped that 3-week win streak.
They did.
The Nasdaq got hammered hardest, down 3.0%. S&P 500 fell 1.6%. We know AI and the shutdown were the headlines. But let's dig into that AI fatigue first. Why now? What made investors suddenly, doubt those massive growth projections?
Well, the problem, I think, is that the whole AI story, the narrative, it's been fueled by future spending, right? CapEx. Companies pouring billions into infrastructure. And the market kind of took that as guaranteed immediate profit growth down the line.
Okay.
But this week, it felt like investors just stopped buying the dream. They started demanding proof. Where's the actual revenue acceleration now? And that skepticism, it just cascaded, questioning the valuations, hitting semiconductors, cloud software. The whole sector felt like it needed a reset, and it got one.
And while that fundamental rethink was happening, you had this government dysfunction just weighing everything down.
Absolutely.
6th week of the shutdown. This isn't just politics anymore. It's causing real economic friction. We saw the FAA order flight reductions. That's tangible.
Yeah. Oh, definitely tangible. And the economic data, it really reflects that anxiety. I mean, look at the labor market. October layoffs, according to Challenger, surged to 153,000. That is, that's the highest for October since 2003.
Wow, 2003.
Yeah. Think post-dot-com bubble, pre-Iraq war jitters, that kind of environment. And then ADP private payrolls. Only 42,000 jobs added. Oof. That's alarmingly low. Shows real weakness, especially in business services and leisure places you'd expect strength in a healthy economy.
So if the job market's freezing up like that, consumers must be feeling it.
They absolutely are. That University of Michigan Consumer Sentiment Index, it plunged all the way down to 50.3.
Lowest since when?
Since mid-2022. And when they asked people why, they pointed straight at worsening personal finances and, crucially, fears about the shutdown. So it's not just abstract political noise. It's hitting household confidence directly, affecting spending decisions, potentially.
Wait, help me square this. Consumer spooked, labor market flashing 2003 level warnings. But Q3 earnings are actually really good. 82% of S&P companies beat estimates. Highest rate in 4 years. How does that corporate strength fit with all this gloom?
That's the paradox, isn't it? And it's probably what prevented an even bigger market drop. Q3 earnings, remember, they're looking backwards. They reflect the economy before the shutdown really bit down hard, before the AI doubts peaked.
Right. A snapshot of the past.
Exactly. It shows corporations were running efficiently, generating cash. But strong past earnings, they can't shield the market forever from policy failure and worries about the future. So the takeaway for the U.S., the rally paused because policy fragility finally won out over corporate resilience. That's the key driver now.
And that feeling, that policy uncertainty, it didn't stay contained in the U.S. It jumped the Atlantic pretty quickly.
Yeah, you saw it in Europe.
STOXX 600 down 1.24%. And the story there feels like cautious central banks kind of stuck, right? Sticky inflation, but also softening economic data.
It's a horrible balancing act for them. Look at the Bank of England. They held rates at 4.2%, which people expected. But the vote, a 5-4 split, that's really divided.
5-4 is tight.
Very. It signals real disagreement inside the BOE. 4 members wanted to cut already, worried about growth. The majority still fixated on inflation. And Governor Bailey sounded quite dovish afterwards, saying markets were fair pricing cuts by early 2026. Keeps a December cut on the table, maybe. And you saw similar cautious holds in Norway and Sweden, too. Everyone's walking on eggshells.
So policymakers are stuck. But the economy itself, is it actually slowing down? What's the evidence on the ground? Consumption.
Yeah, we're seeing consumers pull back. Eurozone retail sales fell again in September. That's 0.1%.
Third month in a row.
Third month in a row. So it's a clear trend. Households are feeling those higher rates. And even Germany, the industrial engine. Industrial production grew 1.3%, but that missed expectations pretty widely. The German ministry itself said manufacturing remains weak. No sugarcoating it.
And for the UK specifically, those weak sales numbers just mirror the rest of Europe. Rising household strain, just as the BUE looks divided.
Precisely. So Europe's caught in this awkward spot. The UK economy looks fragile, but that 5-4 vote suggests maybe some relief, some monetary easing could be coming. But the bigger picture is, without a proper return to growth, any rally based just on rate cut hopes, it's likely to be pretty fragile, pretty short-lived.
Okay, now shifting to Asia. And here we see a real split, a divergence between the big players. Let's start with Japan. It was riding that AI wave, but the Nikkei pulled back hard this week, down over 4%. That sounds like the U.S. AI fatigue, but Japan has its own policy story going on too, right?
It certainly does. Yes, profit-taking hit tech and semis hard, just like in the U.S. But the bigger undercurrent is the policy shift. The yen firmed up quite a bit into the mid-153s against the dollar, and that came right after Finance Minister Katayama explicitly warned against one-sided currency moves.
Verbal intervention, basically.
Yeah.
Jawboning the yen higher.
Pretty much. Trying to slow its fall. And the market reads that, plus continued signs of wage growth, nominal wages up 1.9% year on year, as a signal that maybe, just maybe, the Bank of Japan's super loose policy is nearing its end.
And that hits the bond market.
Immediately, the 10-year JGB yield jumped to 1.68%. That's a significant move. It reflects bets that the BOJ has to tighten eventually because of wage pressure and inflation, so the market's starting to price in the end of an era for Japanese monetary policy.
Okay, stark contrast then. While Japan cools off, mainland China markets actually rose for a second week. CSI 300 up 0.82%. That sounds positive, but is it real underlying strength or something else?
It was almost entirely something else, purely sentiment.
Oh.
President Xi and Trump agreed to a 1-year tariff truce at that APEC summit in Seoul.
Right, the truce.
And that diplomatic breakthrough just calmed trade war fears instantly. Big boost for cyclical stocks, financials, sectors that hate trade uncertainty.
But peel back that layer of relief, is the actual Chinese economy firing on all cylinders?
Not really, no. Analysts were pretty quick to point out, the truce is great for sentiment, but there weren't many concrete policy changes. It doesn't fix the underlying structural issues. Industrial activity, consumption, they still look uneven, volatile.
Got it. So the key difference, Japan's rally pauses because policy might actually tighten, while China gets a temporary lift that masks ongoing weakness.
That's a good way to put it, yeah.
Okay, we've mapped the chaos. Let's look ahead.
Yeah.
The week of November 10th to the 14th looks packed. But that Washington uncertainty hangs over everything.
It really does. We've got 3 main areas to watch that could definitely spark more volatility. First, the U.S. We were scheduled for crucial inflation data. Thursday's CPI for October, Friday's PPI, usually huge market movers.
But then this is a big but to the shutdown.
Exactly. The huge caveat is that these reports, and probably retail sales too, might just not come out, be delayed.
Right.
And whether they're released or not, whatever the numbers eventually show, it's going to reshape Fed expectations in a big way, especially with this whole stagflation-light worry brewing.
Okay, moving to Europe and the UK. Thursday looks key there too.
Absolutely critical. We get the first look at UK Q3 GDP. That's the big test for recession fears, especially after that divided BOE vote.
No, before that.
Tuesday, Germany's ZEW economic sentiment. Given the manufacturing weakness we talked about, this forward-looking indicator from financial experts is really important. Gives us a clue about sentiment for the whole Eurozone, really, and helps gauge ECB thinking. Then there's Eurozone industrial production on Friday, too.
And finally, China. That truce optimism needs some validation from actual data, doesn't it?
It desperately needs it. Otherwise, that little rally could fizzle fast. We get October CPI on Monday, then the big ones on Friday, industrial production and retail sales. That's the first real test. Is the truce translating into factories humming or people spending?
Okay, that's a minefield of potential data points next week.
Before we wrap, let's zoom out again. Policy uncertainty is clearly the main theme. What are the absolute top 5 most immediate threats you think people need to have on their radar right now? Yeah, the risks are definitely skewed towards policy right now. So here are 5 that could really move the needle this week. Number 1, has to be the prolonged U.S. government shutdown.
Still number 1, looming large.
It is. The risk just keeps building. Every extra week potentially shaves 0.1, maybe 0.2% off Q4 GDP. And maybe more importantly, it just grinds down that consumer sentiment, which we saw is already really low. So watch Congress. Any sign of a breakthrough or continued deadlock?
Okay, number 2.
A deeper AI sector valuation reset.
So the pullback we saw wasn't necessarily the end of it.
Not necessarily, because these tech giants dominate the global indexes, right? If this skepticism deepens, if we see a sustained correction in the big chip makers, cloud names, that could trigger a much broader, more painful rotation out of growth stocks altogether. So listen closely to any commentary from those key companies.
Got it. Number 3, you mentioned stagflation light.
Yeah.
That sticky inflation versus weak growth problem.
Yeah, this is the Fed's nightmare scenario, really. The risk is that CPI stays stubbornly high, even while the economy is clearly slowing down. Think that 40K ADP number.
Sure.
That combination is toxic. It can unsettle both bonds and stocks because it makes the Fed's job incredibly hard. What do you tighten into? What do you ease into?
Tricky. Okay, number 4, European growth malaise.
Just continued softness. If the retail numbers, the factory data, keep disappointing across the Eurozone, you push closer to stagnation. The market risk then becomes that the ECB or the BOE feel forced into cutting rates earlier, maybe more aggressively than planned.
And cutting from weakness isn't always good for the currency.
Exactly. It can really weigh on the euro and the pound. That UK GD2 number on Thursday is the big checkpoint here.
And finally, number 5,
China's fragile recovery.
Now, truce bounce needs backup.
It really does. The market bought the story, but if the industrial or retail numbers this week disappoint, well, that could reignite all those deep worries about Chinese growth. And that wouldn't just hit China, it would ripple across emerging markets globally. So Friday's data dump from China is crucial.
Okay, so synthesizing all of this, it feels like markets are just exhausted, right? After months of running on AI fumes and ignoring policy, the narrative now is volatility, and it's being driven by policy uncertainty. Washington dysfunction, central banks caught in a bind.
Yeah, that seems right. And, you know, with this record U.S. shutdown, these clear signals of slowing growth globally, Europe, parts of Asia, the final provocative thought maybe for you to chew on this week is this. Do these high-flying stock markets of 2025 still have the fundamental legs? Or are we actually seeing a structural shift? A shift where policy risk just the sheer lack of clarity, the dysfunction becomes the dominant force, overshadowing even decent earnings for the rest of this year? Really something to think about as you navigate the week.
Definitely something to think about. Thank you for joining this deep dive. We'll be tracking all these risks right along with you.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format. AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.